quite. All right. Yeah, that's important. Because the world of finance is extremely vast, and it's not something that can be covered in a few sessions for that matter. It will take quite a bit. So the goal here essentially is to inspire us and as emerging managers, as the program is called, as emerging managers, to inspire us to deepen our knowledge in the world of finance and to sort of highlight the importance of finance to management. And I believe that we would have quite an enlightening time, and I would then be open to taking questions. I think that for me fundamentally is, I hope, would be one of the most important parts of this session that we would have. So without much ado, I would go through these slides, and I hope I do meet my intent and objective of sort of introducing us into this world. Mr. Okona said a few things earlier, and I know he sent an outline, but we had quite a long discussion, and I confirmed to him that this would be more like a master class. So a lot of things in terms of the nitty-gritty depth of finance, in terms of really going deep, is really something that will take a long time and a lot of practice. So really, again, the goal is to get us started on this journey. And I would share some links where we can going from the knowledge we gather here today, we can go ahead and deepen the knowledge, deepen the study, and learn how to build models and so on and so forth. But I'll try and take as much as I can during the session. All right, so let's get into it. I try to sort of make it as exciting as possible, and these are not like standard slides because of time. These are Microsoft aided slides, so you bear with me. So we often hear the statement, money runs the world, and indeed it does at a sub-spiritual level, let me put it that way. Since this is a sort of kingdom project, I would also balance things up a little bit here and there as far as the kingdom is concerned. So of course, you would have seen in the scriptures that there was something Jesus clearly made a statement that competes with God, right, in terms of the worship of man, and that is money or mammon. It is not for us to hate money. It is for us to understand the place of money, that we're meant to dominate or have dominion over money and be custodians of wealth, and to responsibly deploy such, for the advancement of humanity on the face of the earth and the advancement of kingdom agenda. So, of course, hello? Okay, I thought someone was trying to say something. All right. So yes, Jesus said you can't worship God and mammon. You have to choose one over the other. And what that means is that is what I call the deceitfulness of riches. And that is the fact that a lot of times you find that money tends to be an alternative to fulfilling, quote and unquote, some of the things that we're hoping or praying or looking up to God to fulfill. It's important as believers to understand that it is God that gives the power to get wealth, and it's in trust to be deployed purposefully. So if you take God out of the system, then money or mammon is what is left. So you find that people make decisions based on where the money is. based on the economy. You make decisions even down to what you study in school because you feel that this is a lucrative endeavor. You know, while growing up, a lot of people wanted to do medicine, law, economics, and all of that. And fundamentally, when you look at how your parents even try to influence your decision, a lot of it has economic fundamentals, right? And that is a consideration for money. People make decisions on a daily basis with respect to chasing down the money. Where is the money? How can I better my life? And so on and so forth. And I believe hence the statement that money runs the world. But as believers, we are meant to master money and run purposefully and deploy money to fulfill purpose, right? So finance is the understanding of how money works. Now, whether you're a believer or not, if you are ignorant, you still would not be very skillful and savvy in terms of the management of money. So the knowledge of finance is a fundamental understanding of how money works. So the first thing said there is that one of the key drivers of decision-making for individuals, organizations, and government or nations is money. All right. Sorry, excuse me. I just need to get something. Just a moment. All right. Sorry about that. Okay. I wanted to be mindful of time. All right. So not a few people believe that money is the biggest factor for decision making. Can you all hear me? I need the sidekick on the call so that I know that I'm still connected. I just got a notice about my network.
Sir.
Can you all hear me?
You're connected. Great. We can hear you clearly, sir.
Thank you. Thank you very much. So not a few people believe that money is the biggest factor for decision making. You consider economic impact of making a decision, or economic benefit of making a decision. So economic impact is more like, right, there's a decision to be made, and you want to weigh what's the economic impact of that, right, of the decision we're about to make. And the other is speaking more to actually making a decision, you know, based on the economic benefit. So let us start to sell this particular product because it should make us more money. Or let me get into this particular business because it would make more money. Making a choice, right, decision amongst several options is also factored on the basis of money many a times, or where the money is. So when you have options of whether you should go, and I'll try and use a lot of simple examples. Should I open a barbing salon for men only or for women only? Should I locate this real estate property in this area or not? You know, basically you have capital, you want to deploy, you want to make a decision, and you want to sort of ensure that you are making the optimal decision. Many times you want to check for the economic benefit of choosing among several options. And so because of this need to actually make decisions, and we will get a bit into this, financial experts have come up with several ways of sort of measuring or metrics. There are quite a number of them, metrics with which to measure the economic impact of decisions, you know, to help decision makers, right? So you have, that's where you have all the different metrics: gross profit margin, net profit margin, ROI, IRR, NPV, MOIC, and several others. And if time permits, we could discuss a few of them. or maybe in the course of actually just going through these lessons, we may come across a few of them, and we just make some of them talking points, or points for sort of elaborating and making more meaning out of some of the slides. All right. I'm trying to make this emphatic for us. It's actually just one word: decisions, decisions, decisions. Decision making is part of life, and decision making sort of informs the future. In other words, decisions you make now will impact on the future. And it's important to understand this. And I made a statement here: decisions are the final outputs for managers. And without understanding basic finance, your effectiveness as a decision maker is significant. Knowledge of finance is. Let me put it this way: when you're starting out in an organization, a lot of decisions are being made for you. In other words, you are not part of the decision making within the organization. You are many a times just a foot soldier obeying orders. And sometimes you are not open to why you are being asked to do X, Y, Z, why they are deciding to cut down on price points, or to increase their price, or to expand geographically. You just find that decisions are made, and then you're a foot soldier expected to just execute the order. And that's what you typically find at entry level. But as you start to climb up the ladder within an organization, or even as someone who is running a business, and I think this is really, really important for a lot of entrepreneurs, because the lack of this knowledge is actually one of the key reasons why a lot of businesses actually fail. They fail because they don't understand how money works. And I've met quite a few who don't understand how money works, or the most important thing to watch out for when you're running your business. And, it leads to capitulation. You must know your numbers as an entrepreneur. But generally speaking, the higher you go, and in fact, if you just start a small business, as you begin to expand, if you don't pay attention or understand that you have to start paying attention to finance and start to understand how this works, you may find yourself on the back foot. So as a manager, as an emerging manager, or someone who's preparing to occupy management position, if you understand that finance plays an important role, and you make clear steps, or you take clear steps to actually educate yourself to become what I would call more commercially enlightened, or building commercial acumen, right? Regardless of where you are, when you're able to analyze numbers, understand the impact, you will find that your effectiveness as a decision maker is heightened. And if you are within an organization where perhaps people even at your level probably don't have a lot of this knowledge, but you incorporate it in how you make decisions, you incorporate it in how you build your business case for approvals, and so on and so forth, and you can run a few numbers and just show the impact of that, you are actually coming into a place where you are beginning to understand the fundamentals of finance and its impact, right? So every decision you make, many times, has economic impact. So, for instance, if you are sort of building out a business case, oftentimes you want to check a few things, but two things are fundamental. Is it technically viable or technically feasible? can it be done? Do we have the capacity to execute? And the next thing that most kind of technical people miss out on is the economic viability of the decision that they're making. How economically viable is this decision? It's going to help us cut cost. It's going to increase our top line, and so on and so forth. So there are some decisions you make, for instance, that it will look like, oh, we're going to make more money. But at the end of the day, you may actually find out that you are going to accumulate incremental cost to the point where the net income you're expecting to make from that decision is actually wiped out, and you're probably better where you are than actually taking that step. So this is why this is really important, right? So your output is decision. You are going to be measured based on the quality of decisions that you make as a manager. Quality of decisions that you make. Your understanding of finance will improve your competence to deliver decisions, right? To deliver quality decisions. The way I like to put it is for you to think about, let's say, the process of industrial production, whether you want to manufacture cement, salt, whatever, right? You typically have a mix of raw materials, right? When you start up from the chain, you start from your supply chain, you have raw material inputs, and all of that is going in, and then you take it through a process, right? Machines and people work to mix up all those different inputs, and then the final output is a usable product, right? Something that has more value than the inputs, okay? And that's the process, right? You want to manufacture chocolate, you get your cocoa, you get your milk, you get sugar, whatever else you need, mix everything up, you come up with chocolate, right? Chocolate is more valuable than all the inputs that go into it. So think about your work as a decision maker along those lines. So a lot of your inputs is what you would call data, right? Data. You need to be able to also include the knowledge of finance, right, into your mix of data that then goes through a process called meetings. You have meetings, you have presentations, you have brainstorming sessions with your team, and so on and so forth. That's the process of you bringing all that data, market research, and all of that into the room. And knowledge of finance is one of the things that helps you to mix up all that data, right? And then the final outputs are decisions. Let us launch a new product. Let us kill this product. Let us increase price. Let us move or diversify our distribution. Let us go digital. All those things are outputs, decisions, right? And I don't want you to forget this. And that's why the emphasis on decisions. It's the singular important output as a manager, decisions, right? The quality of your decisions is important. Finance, and I believe a lot of the lessons we have also taken prior to taking this particular one would have also helped us to enhance the power or the quality of decisions that you make as a manager. Let's move on from here. So who are those that make decisions? All right. Who are those that make decisions? We actually mentioned them earlier. Individuals, organizations, and nations. Individuals, organizations, and nations. These three are very key, right? And I want you to put that in your pocket. In the world of finance, I just said we have some fancy names for them, right? Individuals, you say retail, right? I believe we all know what retail implies. Organizations, you say corporates or institutions. Okay. And I'll get a little bit more into this much later in the slide. Nations, national, subnational, if you are not yet initiated, implies your states, local governments, all those subnational, right? National is more like a sovereign state, and then you have the states within them. Typically in the world of finance, you call it government. So when you hear government bonds, for instance, you understand what that means. We'll get a little bit into this, hopefully. So these are three that make decisions. I made a little caveat. In financial markets, and we'll get into that, much later. When you find small sizes of transactions, even if it's a business that's doing it, once it's just within a particular transaction size, it's still classified as retail, because more often than not, it's just one person making the decision, as opposed to like a corporate organization that maybe has a team, a management team at the high level, possibly even a board where the highest level of decision making actually happens, where you go and defend budgets and so on and so forth, and make decisions about capital allocations and so on and so forth. So at the micro level, you still call that retail, right? Because more often than not, you just find that they are sole proprietors, right? Now, I want you to keep this and put in your pocket. Decision making also has a fancy name. You would have heard it many times. Can someone help out? Anyone wants to take a shot at it? Anyone, apart from the big people in the house? Mr. Nelson, keep your mouth shut politely. Anybody wants to make a try? I want someone to make a try, or a few people make a try in case the first person doesn't get it. I think even the background picture should help. What do we call this? Decision making also has a strat. Yeah. Hello.
Yeah, good
Someone
evening.
is saying something.
Good evening. I said strategy.
Okay. Fantastic. Thank you very much. Did I hear the name Stephen, right?
No, I said strategy. That's my question.
Okay. All right. Sorry, I can't see the participants. So I just
his name is Richard, sir. Richard Jeremiah, sir.
Richard Jeremiah. Okay, thank you very much, sir. Yes, that's the fancy name you hear a lot. Strategy. And that's the fancy name for decision making, right? Now, the world of finance is very broad, but for business managers, let us deal with the applicable basics. And I want to talk very quickly, because I suspect that we may have had lessons along these lines already, but I feel it's important also to highlight, and then we will see how all of this sort of marries together. Okay. The first fundamental is strategy when it comes to the world of finance. The first fundamental that you need to understand is strategy. This is one of the key things that differentiates accounting from finance. So I find that a lot of accountants or people sort of wonder what's sort of the difference when you're looking at, when you say finance and accounting, what's the difference between the two? It is a core understanding of strategy. All right. Accounting deals with the numbers, just think about someone who is still more like a foot soldier, right? That's like a basic accountant. Prepare this invoice, do these numbers. They're just putting those numbers together. You will find that there is limited capacity to interpret those numbers in a way that aids decision making, in a way that aids strategy. And well, if you've been in certain or if you've been in certain rooms or been part of certain presentations, you will probably understand the limitations, right, of perhaps just being an accountant. You can be a very sound, very good accountant. In fact, it's a skill that is extremely needed, right? And get very technical with it and understand it and all of that. But when you start to understand how to interpret, or you understand the impact itself, you now move into finance, right? In other words, finance, as I put, understands the strategic imperatives of numbers, strategic imperatives of numbers. Okay, so I find also in my line of work that many folks who want to get into the world of finance or understand finance, or they want to switch up from just being accountants to financial managers, they actually miss out on this very important point, because they sort of kind of like underestimate the work that is required, underestimate the different competencies that are required for you to be an effective finance person. So sometimes in organizations, when you see someone who occupies the role of a chief finance officer, that person at the very core of it is strategy. At the very, very core of it is strategy. He may not even be a qualified accountant or whatever, but he understands how to marry numbers and strategy very, very well, right? So this is very important. So sometimes I find a lot of people just think that it's just about the numbers, just about the understanding the technicalities and all the different ratios and different margins and all of that, and they just do it for the sake of doing it, or probably because they've been asked to do it, without actually understanding the strategic impact of all of those metrics and all of those ratios. Those ratios are meant to enhance decision making. So you must understand strategy. Okay. So back to decision making, and I'll just run through this quickly. Like I said earlier, I believe that we have sort of probably taken some lessons in this already in the process of doing this. So running a business effectively is about making a lot of important decisions, or as it is, crafting a strategic path for growth and sustainability. Okay, that is strategy. And I typically break down strategy into three things. Sub decisions include what? Strategic intents. Strategic intents are typically the things we often sometimes take for granted, or we just craft for the sake of just crafting it because it's just a fancy thing to just do. But if you are mission driven, you'll understand the importance of this. And strategic intent means that what exactly is inspiring you moving on this journey, or pivoting, or going on this path, on this trajectory, right? What is the core that is holding all your strategy together? What's your ultimate goal as a business? And oftentimes it's called your mission and your vision, right? Mission, vision. Okay, so those are fancy things you see on the walls of several organizations, websites, and so on and so forth. And sometimes you can tell when some of them, they just crafted it for the sake of let's just have something because everybody has it. But it wasn't something that, decision makers sat in a room, deliberated on, debated on, and came up with to say, these are our mission as an organization. And these are things that you can alter, you can change from time to time. Of course, your mission is supposed to be a whole lot more long-term, typically, than your vision. All right. And I don't want to go into the details of all of this, but I just want to say that this is just the starting point, right, of making a decision. Yeah, your vision as an organization, speaking to where you want to get to, how do you envision the future? Your mission really speaks to what are you on about? What will you be doing, right, to achieve that ultimate ambition, right, or that ultimate goal? So your strategic intents are more hardcore, they are more permanent. Every other thing underneath that, are subject to changes every now and then. And that's why this is very important. You're not expected to be changing it every year, right? But some other decisions can be changed with time. Then your strategic objectives, which typically is to decompose your mission as an organization, decompose it into clear targets, right, for the entire corporate. And then strategic planning, which then speaks to a lot of things, including your decisions around who to hire, who to fire, how to organize yourself to capture value within the market. It speaks to things around your products, around your branding initiatives, around your pricing model, business model, marketing strategy, and so on and so forth, right? So as a manager, it's important that you have this knowledge on lockdown. I'm not dwelling so much on this because I believe this very likely must have been covered at one point in time or the other within the program that you've been having up until now. But for emphasis, it's important for you to have this knowledge on lockdown, right? Have it on lockdown. It's very, very, very key, okay? Your skills, even as a research person, very, very key. If you have all those fundamentals, it is easy for you to shift into understanding finance, not accounting now, finance. Okay, very, very, very important. So many a times, for instance, when I'm trying to hire people in my team, particularly if I'm looking for experienced roles, one of the things I'm looking out for are people that actually have this knowledge on lockdown. It may not be a formal training, even if I see that there is a show of or a display of the fact that they have a degree of understanding or around strategy. They are critical thinking, analytical thinking on point. Okay, they understand the impact of decision making, right, within an organization. I test for that. For me, that is someone who will grab things faster in helping me within the team than even just taking in an accountant. You understand what I'm saying? All right, because it's easier for you to get to learn the numbers than for you to learn to understand strategy. Okay, sorry, let me just sorry about this. Just need to. Sorry. Sorry, it's slightly an important call, and I just need to go to answer. I'll let the person know I'm in a meeting at the moment. Okay, sorry about that. All right, So I know I've emphasized this a lot, and I believe you'll understand why. So hold those thoughts, very important. Now, the second fundamental now is understanding financial statements. So you can see that in the order of priority, I'm putting strategy first, and then having or beginning to have some knowledge of accounting principles, right? Second, okay? So as an emerging manager, great for you to get strategy right, be well grounded there, continue to develop yourself there. Second fundamental is your knowledge of financial statements, okay? As an emerging manager, important for you to have that to begin to build this knowledge. All right, and there are three financial statements to be understood. So financial statements, it's interesting that they call them statements because they are saying something to you, and that's really the strategic part of everything. So statements, not necessarily in terms of words, but statements in terms of numbers. All you're going to be seeing are just numbers, but those numbers are making different statements to you, different statements, and I will probably say sub-statements, okay? So number one is understanding income statement or profit and loss statement. Number two is understanding cash flow statement. And number three is understanding balance sheet statement or statement of financial position. Income statement, sometimes also called your profit and loss, or even maybe more popularly called your profit and loss statement. Okay, and then we get to understand the difference in these two statements and, you know, how important they are, you know, for making decisions. So at intermittent points, I will stop to share my screen and then probably just show us like examples of financial statements so that we sort of deepen our understanding of this. Okay. So income statements consist of some components. All right. The first is your revenue or your top line, or what you could call turnover in some cases. And this largely speaks to basically how much money is coming in from selling products. So let's take a retail business, for example, a retail business that sells clothes, for instance, or garments. Every time you sell as a business, so let's say you're a guy and you put up a shop and you're selling suits. I want to sort of use examples that we can easily relate with. So every time you sell a piece of suit, what you collect in terms of financial income or money is called your revenue, or your turnover is your top line. And that's how you would state it in your financial statement. So if you are taking it every day, how much did you make today? I sold 5 suits for 10,000 naira each. And so my revenue is 50,000 naira. It's very simple, very basic. Okay. And I think in the process of talking through this income statement, we would, let me see. I think I should use a more interesting example to drive the point home. Let me look at Okay, let's switch it to a fabric maker. All right, I want to keep it very simple, less complicated, yet giving us a clear understanding of, or being able to incorporate the different parts. So let's take a fabric maker, basically someone who sews clothes. All right, so we can even still stick with the suit guy, right? But let's imagine that he actually fabricates the suit. So let's take a Maya Tafo, for instance. I believe we all probably know that name, like the foremost suit maker in Nigeria. Maya Tafo, he makes suits, and he has tailors. He has a full-blown business where they make suits for individuals, very expensive suits. And so every time they sell a suit, what they make from that sale is revenue. Okay, so let's say Matafo sells a suit, one suit for 200K, just as an example. So he sells 5 suits. Today, he makes $1 million. That's recorded as revenue. All right. Now, please, if there's anything I need to pay attention to, I can see charts. Just point my attention to it so that, because I really can't see anything right now beyond the presentation. And I don't want to block our screen because I think Zoom has a way of blocking the screen if I'm not fully on the screen. Okay, so the next you look at is your gross profit. Your gross profit. Your gross profit is what you net as a business after taking out what is called direct cost. Okay. Think of direct cost as this. In some businesses, it gets a bit more complicated, but we'll keep it very simple. In some types of businesses, the direct cost element can be interestingly complicated, but we'll keep it very, very simple so that we understand the basics. So your gross profit is what is left from your revenue after you take out what you call direct cost. Okay, after what you call direct cost. Let me just note something down so that I can help us with that at some point. All right. So think of direct cost this way. Direct cost is that cost that you will not incur if you don't make that suit. Okay? Direct cost is what you will not incur if you don't make that suit. I want that to sink in. In many instances, direct cost may be the cost that you will not also incur if you don't sell that suit. You don't incur it. So in fact, in this case, we can just put the two together. It's the cost that you will incur if you don't make the suit. It's the cost that you will incur if you do not sell the suit. Those statements are very important. So let me break it down. So for Mayatafo to make a suit, he needs fabric, as an example. He needs buttons, as an example. He needs needles, or not needles now. He needs threads, as an example. What else is there to make a fabric? Or make a suit. So those material inputs that need to come together to make that suit forms his direct cost. So if he doesn't make that suit, he wouldn't incur that cost. Very important. It is possible that he has those materials. He has already incurred the cost of having those materials present, which is often the case. If not all, usually some of that material, he would have already bought them upfront in anticipation that he will be making suits. All right. But it is not recorded as a direct cost until he actually makes the suit. It sits in somewhere you call your balance sheet, and we will get there. All right. It sits somewhere you call your balance sheet. Now, I also said it is a cost that you will incur if you don't sell that suit. So imagine that my Atafo has to package this suit, and there is a supplier that sells him packaging material, or he has contracted to make packaging material for the suit. So every time he makes a suit, he then orders a packaging material, right, to package the suit. All those bags, those carrier bags that they will use to deliver the suit, it goes into direct cost. Now, if he's going to move the suit from his factory to deliver to the client at home or the warehouse, and he's going to use a courier to deliver the suit, that courier cost is also the direct cost. So if he doesn't sell the suit, he doesn't incur the direct cost, okay? Because it's possible, for example, that he makes some suits, not necessarily that anybody has ordered or bought them, but then he hangs them in his showroom, right? So already he has incurred some costs, okay, in making those suits, but those suits, until they are sold, he can't account for the direct cost, packaging, and transportation of those costs until it is sold. Very important, all right? Now, the next thing you have, or the next big bucket, as it were, is your operating income. And I'll try and show us an example of a typical income statement. All right. Operating income is what you net in the business, how much money is left. Okay. When you have added other fixed costs in your business. Okay. Now, these other costs are costs that you will incur, whether you sell or you don't sell. So that's the difference. And that's why it's important to separate them, because it gives you insight as well into the business model of a particular business. And it's one of the key things when you're trying to make investment decisions and so on and so forth. All right. And I'll give you an example of sort of how all of those economics work. So the cost that you wouldn't incur, the cost that you will incur, whether you sell or you don't sell, you will incur that cost. All right. I guess a number of people are still coming in. So anytime you see me, I'm just letting people in. Okay. Now, what are examples of those costs? Example is your light bill, for instance, in the business. You have to use power, right? So you have to pay the power company. You know, they come with their monthly bill into your business. Whether you sell, whether you don't sell, you pay. It doesn't matter. Excuse me. If you are powering your office with alternative power as well, diesel cost, all those things, you keep the office running. Whether you sell, whether you don't sell, it doesn't matter. You are going to incur that cost. You have employees, for instance. You sell, you don't sell, you do what? You incur the cost of salaries. You have to pay salary at the end of the month, right? And several other line items like that, depending on how you're running your business. Now, for some businesses, some of the costs could vary. So for example, if I have a workforce where I only pay for direct labor, for instance, okay? Or well, maybe I pay for a mix of, I have some staff that are permanent, my front office, my maybe head of sales and so on and so forth. They're permanent people, but there are some people that only come, okay, for every, so let's still take the matter for business, for instance. So let's say there is a particular, for the sake of just trying to create a difference here. Let's say there is a particular guy or guys with a set of skill that their finishing touch on its suit, right, is key. Okay. So when the other people are finished making the suit, they come in and they have the skill to do like a finishing touch or put some finishing touch on the suit. And for every suit that I'm making for 200,000, maybe I pay these guys 10,000 naira on every suit. So if I don't make that suit, I don't pay them. You understand, right? It doesn't go into my direct cost, right? But because I'm paying them for every output in my business, so their cost is tied to the fact that I am making the suit. So just think about the courier guy that needs to transport the suit as well, right? That cost goes into my direct cost as a business. Do you understand? Okay, so so sometimes you might find that some elements of your operating cost as a business, some of it or a portion of it sometimes goes into direct cost and so on and so forth. So but let's just keep it simple. I've sort of outlined some of those costs that will still go into your operating costs, whether you sell or you don't sell. Okay. Then this is not something you typically find in a financial statement or in an audited account of a particular company, but it's important in the world of finance, and it's important to highlight in a financial statement, as a finance person. It's a key metrics that you look out for. It's called EBITDA, and EBITDA stands for your earnings before interest, tax, depreciation, amortization. Sometimes it may be the same thing as your operating income, but not necessarily all the time. I hope I'm still audible. Can get a notice my internet is fluctuating. Am I still on?
Loud and yes, you're loud and clear, sir.
Thank you very much, Mr. Wonderful. Did I call you Mr. Wonderful? I think I saw the name Wonder or something. Apologies if I got that wrong.
No, you're correct, sir. Anyhow, sir.
Oh, okay, great. So, so your earnings as a business before you make provision for what is called interest, tax, depreciation, and amortization. So interest basically is your interest payments. If you borrowed money and you're paying back interest as a business, you deduct those interest income from your financial statement. The only thing you remove from your financial statement is the interest payment. So if you borrowed 300,000 naira as a business and you are paying interest of 10,000 naira every month for the next 6 months, what you are going to be taking out of your income statement is the 10,000 naira. Okay? The principal is taken out from somewhere else. You don't take it out from the income statement or your profit and loss statement. I will get into that. Okay? So You take out the interest, tax, the taxation, any form of taxes, regulated taxes, and all of that, is part of your, that's what tax stands for there. Depreciation has to do with your equipment in your business. And in this case, you want to think very clearly about your, so let's take the matter for business, for instance, the sewing machines and every other machines that actually contribute to the fabrication of the suit, and any other such that is in the assets of the business, right? You have to depreciate them. You have to account for depreciation over time. If you have vehicles in the business, you have to account for depreciation over time. Depreciation simply means that the value of those assets are depreciating with time, and you have to account for them in your books. And this is one of the key points that is very important in a financial statement. All right, amortization is somewhat the same in a sense, but it just means that you take the entire life cycle or lifespan, right, of a particular asset. Usually you speak to amortization when it comes to things like intangible assets, right? And then you just break them down over, every year, over that lifetime, and you take it out of your income statement as a business, right? And the reason why this is important, particularly for productive assets, is the fact that those assets will become unproductive or become liabilities. They will become more liabilities in your business than assets. And at that point, you want to change them, right? You want to take them out of the business. Okay. I'll give you an example of a real life business that was into cold food. And some years ago, went to their factory in Ogun State, and I was shocked to see big, industrial generators just packed up, probably like 7 of them, just packed up. And it was interesting that they were, because they had to power, they had to continually be on, right? Those generators have to be on for very long hours to ensure that everything remains chilled. And when it comes to anything heat or cold, it takes a lot of power, right? So they depreciate their generators so fast, like they just knock them out so fast. I think within the space of like a year or thereabout, the gen is gone, literally, because it's worked for so many hours, doing heavy lifting work. Okay. Now, this is where, one of the places where businesses run into trouble when they don't understand their numbers, or when they're not accounting for those numbers, right? Because at some point in the business, if you don't understand, for instance, that you need to be putting some money aside to replace some of those assets, you may find yourself in big trouble. So if my Atafo, for instance, is just running the business, is not paying attention to all those machinery that actually help to produce those suits, and let's say you just bought a set at the same time, you just bought a set of 20 machines, suit producing machines at the same time. And ideally those machines have a lifespan of, say, for the sake of it, 3 years, right? And it's not paying attention to it. So every money the business is just making, everything is just going into other things, going into personal account and going into different other things, and nothing is being set aside. At the time that it needs to replace the machines, when the machines start giving serious headache, when in the middle of production, you're calling repair people, the machines, when the lifespan is going off, what often happens is that it then starts to incur a lot of cost in terms of maintenance. So you're always calling somebody to come and repair, come and repair, come and repair, right? And when you intelligently do it, do your numbers, you would see that, look, I'm better off just buying a new machine. When it starts to affect your delivery, the business client ordered a suit, and you are missing your deadlines, it's affecting your business, affecting your sales, and all of that. But for some business people, for instance, they don't have the capital to take out of their business and go and buy a new machine, right? No capital to go and buy a new machine. Then they are struggling with the business, right? The business is actually in danger at that point because your machines are depreciating. They've probably depreciated, maybe out of 20, you only have 10 left. They've told you, oh, these other 10, they are gone. Let me tell you why this is important as well in terms of insight. If you are not accounting for that cost, when probably you should be selling your suit, just for the sake of the example, if you are accounting for that cost, probably you would have estimated that I must be selling every suit for 250,000 naira. Okay, to ensure that I cover the cost that I will need to buy new equipment when need be. It may not just be about new equipment, it may be about more modern equipment, it may be about upgrading your equipment, several other things, right? You want to put enough margin to cover all your costs. Okay? If you've been selling the suit at suboptimal cost, you really will struggle to pull out money from the business to replace your machines. And you may find it very, very difficult, perhaps, to even get financing to buy your machines because your historical numbers don't show that you are capable as a business to actually replace those machines. And it may be very, very tough for you. I will talk about this, a little later. I know I've taken quite a bit of time here, but very important, okay? And after you've taken care of that cost, then you have what is called your net profit, okay? So I think perhaps I should go through everything before maybe I look for an example of the financial statement and sort of run us through, all right? So after you've taken care of all that, you now have your net profit. And in accounting principle as well, your net profit or the cumulative of your net profit is where you should take out money as a business owner. That is where you should take out profit or what you will call dividend as a business owner. So if you're a business owner, or on a broader scale, on a larger scale, you talk about shareholders, right? So shareholders, they share profit. They don't share from the cash flow. You have to ensure you are sharing from profit. Very important. And you don't eat up all your profit as a business. It's not best practice to eat up all your profit. So if at the end of the year, boom, you see your net profit, 20 million, you want to take it all out, right? There's something else you need to consider before you decide on how much you take out of the business, okay? So even if you look at publicly quoted companies, you see they declare profits, then they say, oh, they're going to pay X Naira per share, to shareholders. You go and check, you find that they're only sharing a portion or a fraction of the profit that they declared, because your profit is accumulating, as it were, into a war chest for you to continue as a going entity. Okay, so the income statement is, for several reasons, is where I would say a lot of creativity happens. A lot of creativity happens. And how do I put this? Let me just put it that way. so that I don't get off on a different track. All right. Let me just use that word, right? A lot of creativity can happen here. When you understand finance and you're working with a very sound accountant, plenty creativity can happen here. All right. I won't say more than that. But there are other financial statements. The second one is your cash flow statement that consists also of three major components. All right. The first is cash flow from operating activities. And this basically speaks to the cash or the net cash from your operations as a business. So your revenue, you deduct your direct costs, you deduct your operating costs, and all of that. You would have a net cash flow from operating activities. Okay? Net cash flow from operating activities. So basically, the operations run as a business. And we'll look at some examples just to drive home the point. I think I should pick some speed at this point. Cash flow from investment activities. So this speaks to your cash flow. So when you talk about cash flow, just think about the in and out of cash. So that's cash flow, the inflow and outflow of cash. So cash flow from investment activities usually is outflow of cash. Okay, usually is outflow of cash, except when you are playing treasury. For instance, you can have sort of inflow of cash. So outflow of cash. So investment activities are speaking to, for instance, when you are buying new equipment for the business, you are buying new trucks for the business, you are buying new machinery for the business. Those are investment activities. Okay. Those are investment activities. So you're investing in acquiring assets into the business. All right. Then the third is cash flow from financing activities. So I will get into this, I think, towards the last slide. Cash flow from financing activities is basically how the business finances its operations. So if you go and borrow money, for instance, that's a financing activity. If you go raise equity, that's a financing activity, right? So all the activities, sort of flow of cash, right, that is coming into the business to sort of finance the operations of the business. Okay, so that's your cash flow statement. All right, and then the last statement is your balance sheet statement, where you have your assets, which consists of your current assets, your investments or non-current assets, and your intangible assets. There are others as well. So current assets speaks to assets that you can easily, quickly convert to cash. It's either your cash or things that you can easily convert to cash. So for instance, yes, your cash balance in the bank is an asset, all right? Inventory that you have is an asset. So if you have inventory, if you're trading FMCGs or maybe like Limayatafo, you have inventory of suits that you will sell to convert to assets. Convert to cash. Okay, those are assets in your books, your balance sheet. Now, your current assets, basically, the rule of the thumb is that anything that you can easily convert to cash within a 1-year cycle, right, is a current asset. Okay, cash and cash equivalent, inventory, so on and so forth, current asset. Investments or non-current assets are assets that you cannot easily convert them to cash. Okay, they may be land, they may be properties, buildings, what else? Even your equipment and so on and so forth. Those are non-current assets within your business. All right. Intangible assets speak to things like technology, so for instance, if you've done an M&A and you've acquired the assets of other, or the tangible assets of other companies or another company, all right, and they have sold to you intangible assets. I don't want to get too technical now, but for instance, they can put a price on their goodwill, for instance, and you've acquired that into your business. You have to also, it has to also reflect in your balance sheet. And sometimes there's what you call a revaluation of those intangible assets. Okay, so for instance, I may not even be making any money as a business, but maybe I have a customer, or sorry, I said 5,000. Let's that's an asset that you want to buy from me, and I put a price to it. When you acquire it, you have to recognize it in your books as well. There's an accounting principle that you can't recognize. You have to recognize, or you can't put a market value on internally generated assets. So, for example, you have a technology that runs your business, that your developers within the organization, they were the ones that built it. Okay, you can't just come and say, hey, my tech, you put it in your books. You can't do that. Even if that's the value in the market, you can't do that. You have to sort of capitalize the cost of that development. So, for instance, the salaries you are paying to your developers, you can take all of it, or intelligently take a portion of it that you feel this is the actual man hours that went into developing this asset, okay, as an accounting principle, and then you capitalize that amount of money, all right, and then you recognize it as the cost of your technology, or the value of your technology in the business. Okay, it is different from the market value. When you want to sell the business, you can now put a market value on it. So at arm's length, a willing buyer will say, well, I think your technology is worth 100 million. Fine, I'll pay you 100 million for your technology. Even though in your books, you may have recorded maybe 5 million naira against it. Okay, so that's maybe a bit on the side. Then you have your liabilities. Okay, you also have current liabilities. In other words, obligations that are due in less than a year, obligations that you have to pay out in less than a year. All right, current liabilities. For instance, if you have tax liabilities, you want to put it here. If you have debt liability, short-term debt, okay, you want to put it there as well. Maybe you've borrowed money for a tenure of 1 year or less. It's a current liability. You put it there in your balance sheet. Long-term liabilities speak to liabilities that are extended beyond a full year. Okay. And then equity. This is just a very simple breakdown. Equity speaks to your share capital. Your share capital is basically so you have your share capital, which is the amount of money you've paid, for instance, to register your business from CAC. They give you 1 million shares. All right, that's part of your share capital. Then there's what you call share premium. In other words, if you then sell that 1 million shares, right, at a particular value, the difference, you account for it in what is called your share premium. Okay, like I said, I'll give us pointers to maybe get a bit more familiar with some of these things. Then your retained earnings is actually your net profit after you've taken out dividend. So what is left of your net profit every year after you've taken out dividend, you put it in your retained earnings. So if I have retained earnings of 5 million this year, I make a profit the following year of 20 million, I take out my dividend, you know, what is left there, I added to that 5 million from the previous year, and it becomes my new retained earnings. Now, there is a rule. You think about it, it makes mathematical sense. Your asset is equal to your liabilities plus your equity. All right, liabilities plus your equity. So if you know, simple arithmetic, it means your equity is your asset minus your liabilities. And I think it makes sense, right? Things that you own in the business, your assets, then things that you owe other people, your liabilities, things that don't belong to you. So assets belong to you. What doesn't belong to you are your liabilities that you're owing other people, right? So when you subtract your liabilities from your assets, what you are left with is your equity. That is your actual ownership or your net ownership of the business. Okay, so, and that's why it's called the balance sheet, because everything must balance. So your assets must be equal to your liabilities plus your equity. If your balance sheet is not balanced, it means there's something wrong with your numbers. And this is one of the reasons why they would say numbers don't lie, quote and unquote. All right. So everything must balance out in your balance sheet. Now, let me backtrack a little bit to your cash flow statement. Your cash flow for a business manager is the most important of your financial statements. Your cash flow is the most important of your financial statement. The reason it is the most important is because liquidity is very important. In fact, when investors are coming to value your business, they value your business on your capacity to generate cash. Cash is king. The capacity of the business to generate cash is important for valuation. All right. So let me speak very quickly, just on the basis of that, to some of the metrics used or the approaches to valuation. So there's what you call EBITDA multiple. Remember when we talked about EBITDA? Which speak to the net cash. In other words, depreciation, when you take it, is a non-cash item, right? You subtract it, but it's not a cash item that you're subtracting from the business, okay? So you take all of that out, depreciation, amortization, okay, tax is an obligation to government, let's take that out, right? As a business, how much cash are you making? They value you based on your EBITDA multiple. It's one of the most popular approaches to valuing a business. In other words, they look at your business, what is the EBITDA of the business, and they give you a multiple on your EBITDA. 6x, 4x, 10x, for instance. And they do that usually on the basis of what is called comparables, or what you would call market valuation. So they look at a similar company that is probably publicly quoted, or they have knowledge of a private transaction that happened, okay? So if it's publicly quoted, they call it trading multiple. If it is private insight, right? They would call it a transaction multiple. So for instance, you have a microfinance bank. It's not publicly quoted, okay? You have, let's even go back to the Atafo business, right? Now imagine you're running, let's imagine it this way. You start a tailoring business, and my Atafo as a business has become publicly quoted. He has gone public, okay? And somebody wants to buy your business. What they will do at the EBITDA level, they go and check my Atafo's business. Because it's publicly quoted, all the financial statements have to be made public. That's the rule. You have to publish it publicly. So they go value of Atafo's business. So Atafo has a market cap of 5 billion naira. Okay. So yes, investors have said this business is valued at 5 billion naira, right? They look at his EBITDA and they say, what is EBITDA? How do I put this? What is the multiple on the EBITDA that equates to 5 billion naira? So maybe he made an EBITDA of 500 million, right? So it means that it's trading at a 10x EBITDA. 10 times 500 million is his market cap, 5 billion. Okay. So they come to your own business and say, fine, since you are running a similar business with Atafo's business, we're going to look at your own EBITDA as well, and we'll give you a 10x on your EBITDA. It's often not like that. It's often not simple like that. Usually, they do what is called discount. They discount your business for various reasons. But I don't want to go too deep into that. But just to keep it simple, you won't likely get the same 10x. By the time they do the discounts, the applicable discounts, technically, it may come down to maybe 7x of your own EBITDA, all right, for various reasons, which I would not want to discuss because of time. Okay, so that's one of the ways they put value to your business. Now, if they are going to go the very technical way, which is called the discounted cash flow model, you can see that at the end of it all, it's still about cash. Now, the discounted cash flow approach, which is called DCF, acronym is DCF, okay, is sort of like the standard bearer when it comes to valuation. It's like the gold standard when it comes to valuation. In other words, you are looking at the business and you are really going deep into that business and you are considering the business on its own merits, even though at some point you'd also go and refer to the market. There's a part of the process of calculating or going through the discounted cash flow model where you still need some market metrics to determine the value, okay? The market is always important. So sometimes you find some people say, no, I don't want trading multiple. I want transaction multiple. It really doesn't matter. Because even when you find a transaction multiple, in other words, a private company, so for instance, you hear that Flutterwave is not yet fully, but you hear that, Flutterwave as well anyway. But I think everybody heard Paystack, for instance, was acquired for $200 million, okay? Paystack acquired for $200 million. Now, if you have knowledge of Paystack's numbers, right, it means you can do what is called a transaction multiple because that happened privately. It's not trading. In other words, it's not fluctuating, you know, from maybe day to day or week to week or month to month, quarter on quarter. Okay, it's a transaction multiple. Oftentimes, even the transaction multiple, they still look at the market to sort of determine a transaction multiple. So it really doesn't matter which one you use, but you can always use market multiple because in the finance world, there is some debate around that, okay? But everybody still looks at the market. Ultimately, you still look at the market, okay? So so you still look at the market in discounted cash flow, but it takes a whole lot more about the nuances of the business, right? And then it forecasts the business. Now, you would hear some arguments about, no, we don't want to use your, we want to use your historical as a business to value you. We don't want anything that is in the future because the future is not promised. The statement, it sounds like it's sound, but at the end of the day, it really is not. And the reason is this: every decision is futuristic. That's why you need to understand strategy, right? Everything is about the decisions I'm making now that is going to impact in the future. So, for example, something happens in the market. Let's even look at the current situation. There is inflation, okay? Government trying to control the inflation increases interest rates to take away money from the market, okay, to stem inflation. And this has led to the drop in the stock market prices. So there are businesses, you look at MTN, for instance, in Nigeria. MTN is still making crazy amounts of money. And for the sake of it, for everything one can see, MTN will continue to make a lot of money, right? But guess what? Their share price dipped because investors have factored the future into the present. Everything is looking forward. There's really nothing about looking backwards, right? So even if you take a multiple in the market, you want to apply it to the last 12 months trading of a business, right? I hope I'm actually not speaking over people's heads. I'm sorry. Okay, I'm sorry if I am. I would allow for questions. I'm really sorry. I've been told I tend to do that a lot. Okay, but let me just close on that note because I think I'm getting a little too technical. Okay, so basically what I'm trying to say is that your cash flow statement is the most important financial statement. Okay, your DCF is still about your cash flow into the future. Okay, and if you run out of cash in a business, your business is technically dead. That's when you say a business has gone bankrupt. In other words, it doesn't have sufficient money, cash, to pay and to continue operations. When you run out of cash, you run out of business. That's why I said in the matter, for example, if you don't have cash to purchase and replace those assets, if you can't get from the bank, you can't get from your family, you can't get from anywhere, your business will tank. It will be the end. You know, it will just start to die slowly. Your employees will be owed salaries. They will start to leave one after the other. Your customers will be disappointed. They will start to leave the business. You won't be able to pay your NEPA bills. You won't be able to pay your, everything just starts to tank. You can't buy supplies. You can't, trouble starts. Once you run out of cash, trouble starts. And this is one of the key reasons why a lot of businesses have failed. They run out of cash. Okay? And so you have to watch your cash flow. Very important. Stay liquid. And that's why you find businesses going to raise money, because they need liquidity to continue as a business. All right? So some news came out the other day. Some of you may have seen it. Kuda Bank incurred how much loss? 16 billion naira or so, 6 billion or something like that. I wasn't surprised because I've seen their numbers from Q1 2022. I think I already saw them. You know, they're making losses. It's not surprising, and it's really not an alarm, right? They're making losses is not an alarm, actually, right? So long as they still have a lot of cash in the business, there's still hope. Once there's cash, there's hope. Just get that into your mind, right? So you need to watch your cash. Amazon, for instance, you've probably heard the story. Amazon continued to make losses for 10 years before they eventually just tried to turn profit. Okay, 10 years loss making. They kept on raising money and they kept on growing. All right, and that's a discussion for another day. But that's where strategy also comes in. What's your growth strategy? Right? It comes in. What's the strategy you are pursuing? All right. So if Kuda, for instance, it's something to take note of. I'm not saying that, you know, those massive losses is not important, but they are still in business and they'll be in business, except they can't raise money again and they are no longer profitable. And that's why businesses die. You can go and check out the business, as maybe some of you who sort of take interest in this. There is a business called Airlift. I think that's the name. It was supposed to be one of the unicorns from Pakistan. They died 1 year after raising 85 million US dollars. They died, right? That's another story for another day. Okay, but cash flow is key. Okay. There are a lot of analysis you now start to do around your numbers. So your balance sheet, it's often typically called statement of financial position. The reason is that your balance sheet intelligently actually gives a snapshot of where the business is. intelligent snapshot. And there are all kinds of analysis that you can do, right, on the balance sheet. So from the balance sheet, you start doing your investigations. So for instance, part of what we do a lot of due diligence on investments, acquisitions. An investor wants to invest, or private equity wants to invest in a business, acquire shares in a business. They tell us, go and do your due diligence. They hire us to go and do due diligence, right, on the business. As finance people, what we do due diligence on is the balance sheet, because numbers don't lie. So we start from the balance sheet and start to tear the business apart, right, from the balance sheet. And there are inputs that go into every part of the balance sheet. So you are investigating all those inputs, because it's a statement of the position of the business as at a particular period. It gives you a snapshot of the business as at a particular period. And it tells you how big a business is. It gives you an accurate picture of the size of the business, right? And one of the interesting metrics you look out for is you test for working capital stress. Working capital really speaks to cash that you use to continue to run this business. So for example, if your current assets is lower than your current liabilities, it's a sign of trouble for the business. It's a sign that the business has working capital challenges. You understand? It means that you don't have enough current assets to actually cover your current liabilities. So if all the people you are owing call for their money, the business doesn't have cash to pay for it. You understand? No cash to pay for it. So going back to cash flow, they have to go to look for cash flow from financing activities. If you can't get cash flow to finance, your working capital requirements is actually beginning to make a debt statement on the business. Okay. And I hope I've tried, to sort of give us an insight into this. I'll show us some examples, but let's quickly move because of time. So I said here, and I think I've already said it in passing, remember strategy and decisions. How does it all come together? How does this all come together for a manager? Very simple. Your financial statement is a reflection of all your decisions as a business or even as an individual. Your strategy as a business reports in numbers. When you go deep dive into the numbers, it tells you the decisions that were made about this business. So oftentimes, when we're doing transaction advisory for a business, we would ask not just for your current financial statement, especially if you've been in the market for quite a while, we would get your historical financial statements. Usually, if you've been around for more than 6 years, we want to at least have 6 years financial statement. The reason for 6 years is that, for instance, in Nigeria, by law, the FIRS can go back 6 years into your business to pull out your liabilities as a business. All right, anything beyond 6 years is gone. So they have the authority to look 6 years backwards to track your numbers and say, well, this is how much you are owing in taxes, and so on and so forth. Okay, now beyond all of that, your historical also gives us an insight into how your business has grown. Okay, and the numbers make us to ask questions. In other words, we are questioning the decisions that were made in the business. Okay, so whether you plan well or you don't plan well, your failure to plan would also reflect in your numbers. Okay, And everything is informed from strategy. One of the things in the strategy is also your competitive landscape analysis or market analysis, economic analysis. You need to be strong in your research as well, because those are exogenous factors that affect your business, right? And that's why elections are important for people, okay? Because electoral or political power actually has overarching effect on the business landscape. The decisions made by people in governmental authority, all right, is key to affecting the business environment, okay? And that's why you see Dangote, for instance, he will go and sponsor political parties because he wants to influence political decisions or decisions that will affect him as a business. Some of you probably saw that he went to Kenya. He was there right in the VIP, you know, when the new Kenyan president was being installed in. People who have high stakes, they understand what it means to cut governments, right? If you've read the story or seen the movie, The Men Who Built America, you'd see how the billionaires in America, Rockefeller, JP Morgan, and co, came together to decide to use their money to influence who comes into political power, because they understood that political power actually would have effect on them as business people. So business people don't shy away from politics. You have to be interested in it. Election years next year, make the right decision. That is just on a side note, okay? So all your strategy reports in numbers. It reports in numbers. And this is where both marry themselves together for finance people or for managers who have come to really understand the importance of finance, okay? So if you look at publicly quoted companies, for instance, and when they pull out their numbers, they pull out their numbers and all of that, there's a common statement that you find. They talk about facts behind the numbers. Facts behind the numbers. I'm sure you'd have heard that, you know, over and over. In other words, they are speaking to the decisions that are informing the numbers. Why are these numbers this way? Why is your profit? Why did it dip? Why did this skyrocket by 100%? What were the things that you made? Oh, we dropped our price and then we went into a new market. We acquired another business and that's why our numbers have gone this way, so on and so forth, right? That is how you marry strategy and accounting knowledge, right? To be an effective business manager. When you grow and you're at a certain level, for instance, when you start to manage maybe an SBU, in other words, a particular line, a critical line of business for a particular entity, in other words, what it means is that you have P&L responsibility for that business. So you're expected to bring your numbers for that business down to gross profit. And sometimes when I'm advising businesses, I say add the direct cost, that is not the direct cost now, the cost of staffing. So take everything, shared service and all that, the cost of staffing, put it and let's see how you're doing as an SBU, all right? So these things are very important. Now, and I think I should be closing shortly. Remember the three entities that make decisions. Many times they need to fund their strategy. So what are the three entities that make decisions? Retail, corporate, governments. So when you hear that Nigeria wants to go and borrow money, to finance its budget, what it actually means is that it's going to borrow money to finance its strategy. And what many people are questioning is that, what is your strategy, right? What's the strategy for economic growth? How are you going to stimulate the economy? And so on and so forth, right? And a lot of eyes, that's why you see a lot of analysts go into the capital expenditure, right? Capital expenditure is your cash flow from what? From investing activities. Okay, cash flow from investing activities for a government. So they are looking at it and say, what are you going to be investing in to open up the economy? Because when you open up the economy, building infrastructure, what it means is that you are enabling the business within those environments to thrive, or you're enabling new businesses within those environments. Okay, and when you enable those businesses would pay taxes. You make money from VAT payments, you know, commercial activities, and all that's how government should ideally be making its revenue. All right. So that's what investors want to look at when they are borrowing a government money. Okay. But fundamentally, they are looking historically at your cash flow. Very important. And I'll speak to this in a bit, you know. So I said there is a market where they buy money from those who sell money to fund their strategy. So there's something called financial markets, okay? Financial markets. Financial markets, what is happening there, largely, when you see market, once you see the word market in business, don't need to complicate things. You are just looking at a place where something is being bought and where something is being sold. Alaba market, buy spare parts from there, from those who are selling spare parts. The financial market essentially is where you buy money from those who sell money. Now, those who sell money, interestingly, are those you would call market operators. And the interesting thing about the financial markets, okay, is that those who are buying and selling are oftentimes one and the same people, okay? So you're either trading up or you are trading down in a sense, okay? So retail people go to the market to sell their money, all right? They also go to buy money. So as an individual, for example, when you go and borrow money from the bank or from all these loan guys that thankfully SEC has banned a number of them for their very crazy malpractices. Okay, what you are going to do is you are going to buy money. All right, you are going to buy money from the market. Okay, as an individual, when you go to the market and you go and invest your money in treasury bills, or you buy the shares of a publicly quoted company like MTM, right? You went to sell money. Now, obviously, there are risks to buying and selling, all right? And risk is really at the center of the financial markets. Risk is at the center of the financial market and dictates literally a lot of things. In fact, is a fundamental bedrock, and I may not get into that today, okay? So all these three entities, they go into the financial market to buy or to sell money. As a business, you have excess cash flow, you have a sound finance person who knows where to put that money, where it won't get lost, or to trade that money, okay? So as a business, there is no need for you keeping excess cash in your business that you don't need. It's not efficient. That money is actually going to be depreciating in value. So you want to invest it in something that would appreciate in value, and depending on just how the risk appetite of decision makers, but by and large, for a business, a continuing entity, where you are not in the business of investing money, particularly when you are not in the business of investing money, you want to put money in risk-free assets or assets that have minimal risk. And what are we talking about? Government bonds, right? That is the asset with the considered to be the least risky assets globally, right? It differs from country to country, and that's where you call something called country risk factor comes in, for example. And I'll just give this example. If I can't find a publicly quoted tailoring company in Nigeria, and I find it in the US that there is this big company that does tailoring like Maatafo and is publicly quoted, right? If I'm going to base my comparison on that US, there's something I need to factor in. It's called country risk factor, because Nigeria is a riskier environment than the United States, okay? So I'm going to charge a premium, right? Either in discount or in interest rate for me coming to invest in a business in Nigeria, all right? The same business in Nigeria will pay more for my money than a business in the United States or any other country that is considered, you know, more economically stable or advanced than, you know, Nigeria, for instance. All right. So there are two basic ways to trade money, right? To buy and sell money. Two basic ways. Number one is equity, and you buy equity with shares. All right. You buy equity with shares. Shares is the commodity that you buy with money when it comes to equity. So if I want to buy shares in a particular company, I give you my cash, my money, and you give me shares in return for that money. All right. Whether it's a private company or publicly quoted company, that is what happens. So two primary ways. That is what you also call a mix of debt, equity, or instruments that have quasi-debt, quasi-equity, like convertible notes and all of that, where it's a debt that can convert to equity and all those other types of interesting mixes. The financial markets actually can be quite complex, and you need to choose your specialty if you are going into core finance. But this is emerging managers program, right? So you just need to understand the basics, because as a manager, one of the things or decisions you'll be involved in making as a manager is, what do we do when we need money? What do we do? Do we go for debt or do we go for equity? It's a decision that you have to make. So you need to understand that there are two primary ways of actually raising money. You go for debt or you go for equity. Debt, I say you buy debt with trust, all right? Trust because it is actually tied to what you call interest rates. Both are tied to what you call interest rates, but particularly debt is a more direct element. Interest rate also affects equity market, but more directly affects the debt market. And the reason why you are buying with trust is that the more trusted you are, the cheaper you can buy money from the market. And I'll give you an example. MTN, big entity, rich cash flow profile, and so on and so forth. MTN goes into the financial market and goes to raise billions from institutional investors. Okay? When they raise debt like that as a corporate, you call it commercial paper. Commercial paper, which is a type of bond that you issue. A bond is a debt, is a promissory note. So MTN goes into the market, and you'll be surprised. MTN is able to buy money from the market at 5% interest, 5-6% interest rate from the market, right? But a smaller business, like another one that I know, has to raise a commercial paper, but they are paying 18% from the market, more than 3 times what MTN is paying in the market. What is being traded there? Trust. What is the trust? The trust is that MTN is a less risky organization for me to give my money. So the smaller you are, the more expensive you will buy money. And that's maybe not the most accurate way to put it. I think more accurately, that in itself is technically correct, right? But more accurately is that they are going to look at your historical, your cash flow profile. Are you able to finance this debt looking at your cash flow, right? And that's why I said earlier that when I was talking about the business that may go bankrupt and all of that, if you are not paying attention to your cash flow as a business, if you're not paying attention to your cash flow, if you are not pricing your product correctly in the market, okay, and in a way that you have enough cash flow to show that you can finance acquisition of new assets that you need to continue to run as a business, then you may find it difficult to raise cash from the business. Eric, can we unmute? Can we unmute? I'll soon be through. Can someone help to mute everyone? Okay. So yes, as I said, if your cash flow doesn't demonstrate that you can pay back the money plus interest, then you find it very difficult to raise money from the market and your business may die, right? And so that's part of why your cash flow is important. So I think I would probably stop it here and maybe let me entertain some questions at this point, and then maybe I can look for a particular financial model and use that to sort of take us through an example of what we are talking about. So please, questions from anybody? Any questions? If there are no questions, then there's problem. I'll feel like I didn't achieve my objective.
It's easy to get advanced to mobilize the site.
Hello, sir. Good day, sir. Thank you very much for the session.
Thank you.
Yes, we are here.
Yeah, I think that there's a question on the group, a group question on the platform.
Oh, okay.
Yeah.
Okay, let me look at it. Sorry, just a minute. I'm trying to pull up an example to show. I would come back to the question.
Okay, let me read the question for you. Someone was asking, thank you for today's class. Are there accounting apps that one can use to help with the bookkeeping? Asking a situation where one business is in a competitive market that has a sort of fixed price and overheads eating into one's net profit. How can one scale? Well, that's a generic question, though.
Okay. Accounting, I think there are several accounting softwares. Depends on business is also being run. So you have QuickBooks, you have Zoho Books. Zoho, I understand Zoho is also very good. You have Sage. Sage is good. So there are several accounting softwares. There is Wave. I don't know if Wave is still around in Nigeria, but I think they were around here. I think they're still there. You can sign up to Wave. There are quite a number, and I'm sure there are those that were done locally as well that you may just check online and see that maybe you don't have to pay dollars for. I think even Sage, you don't have to pay dollars for it. I think Sage collects in Naira and they are able to repatriate in dollars. So in terms of accounting software or platforms, those are some that you can consider.
Or perhaps a basic Excel sheet can suffice for now.
Yes. Basic Excel can work. Basic Excel can work.
So, okay, let me ask the class. Even I've been multitasking. We have an investment memo we have been developing with a DFI over here. So I'm just having to go through that session and now pop into this session. But I've overheard a significant amount of lecture and it's quite insightful. So I want to ask, like Mr. Dijali already asked earlier, do you have any questions, comments, observations, inputs?
For the second paragraph, on the first line, I think there should be like a comma that's covered between it and the
Gentlemen, you are scaring me. And ladies, if we don't have any question,
maybe
it's either high level.
It's either I spoke too over the top, or it can't be that it was all just very well understood. I don't think so, because even if it's well understood, I think typically you'd have questions. So I would probably think it's the earlier one.
Mr. Jeremiah,
let me just show a sample. So if you can see my screen, this is like a sample financial model. I would say technically a sample, okay, but this is real work, okay. So you have revenue there, you have the direct cost, you have gross profit, and then your gross profit margin, which is very key. So sometimes you find that businesses, or one of the things you want to analyze is what is called unit economics of a business. So the unit economics of the Mayatafo business would be to say you break down all the suits sold, right? And you take just one suit as a unit, and you want to find out the unit economics of that suit, right? Where you start from is the margin you are making on one single piece of suit. Then you want to even now leverage all your operating expenses. So you see all these operating expenses, human resource, marketing, rent, other salaries, and all of that. And sometimes you find that there is a lot of breakdown, under each one like that. Okay. Okay, that then accumulates to just those broad headers. You want to leverage other costs, even on that unit, right? You divide it till you get a unit, and you want to check whether on a unit level as a business, right? Are you profitable? You take outside any incidental cost and all of that, just to judge the business based on its unit economics. Does your unit economics make sense? Are you profitable at a unit level, right? So it speaks to operational efficiency, and then you start crafting strategies to improve your unit economics, for instance. So you can see EBITDA is there as a business. So if you are making losses as a business, or you're making EBITDA losses as a business, right, which you'll find in this new world of tech and fintech, where the rule is grow fast and break tables. They don't care about profits. The investors just want to give you money. Just grow fast and dominate the market. You know, they actually give them a multiple of revenue. So you can see it's still a case of cash, a multiple of revenue. Okay, that's how most of the fintechs are being valued today, multiple of revenue. So you find some of them that raised a lot of money. They are going into acquisition of other businesses to shore up their revenue so that they can come out and say, oh, I'm now a unicorn. So if my investors have been giving me 10 times my revenue, I'm targeting that, oh, let me just hit $100 million in revenue, and I can boast that I'm now a unicorn. For instance, Flutterwave's numbers, when they first announced that they became a unicorn, Flutterwave's revenue was clearly what they gave them was a 10x of revenue, almost 10x. Flutter was about $90 million in income, right? But they may be making losses. So here you have your income statement. You can see cash flow from operating activities. And so here is taking your earnings after tax and then making adjustments. So non-cash items go out. Your depreciation goes out. Other things that you have probably computed goes out. Then cash flow before changes in working capital. Then you have changes in working capital. The changes in working capital is important because it speaks to your payable and receivable. Okay. And that's what plays into your free cash flow as a business. So if your net changes in working capital is positive, it means that your valuation will be more positive or more improved because you are retaining more money within the business before you pay out. So let me tell you the strategic importance of that as an example. That is why you find that if you are a vendor to large corporations, they will give you a 60-day payment cycle, typical of some. Some will do 30 days, some will give you 60 days. So in other words, from the time you deliver the product or the service, you are going to wait 60 days before you collect your money. Sometimes your full money, sometimes it's your balance money. Okay? It's not like they don't have the money to pay you. It's not like MTN doesn't have the money to pay you immediately you deliver the money. What they are trying to do is they want to delay paying their payables so that their receivables come in faster than they need to pay out money. And it's very important to managing your working capital. If you can ensure that the times that you need or the amount of money, and it's usually a time factor, right? You are extending your payables, but you are getting your receivables faster than you are paying out, right? You remain liquid as a business. It helps your liquidity as a business. It's a very important element. And that in itself, that tiny thing you are looking at there has created a different financial market called invoice factoring. So if MTN is owing me 50 million, Hello? If MTN is owing me 50 million naira, and I have to wait 60 days to collect that 50 million naira, everybody knows MTN is good for their money, right? Because they are trusted. I can take that money and say, me, I can't wait to collect, I can't wait 60 days to collect my 50 million naira. I go to another entity who buys that invoice from me, right? I sell that invoice at a discount. And maybe I just say, 50 million naira now, sorry, 40 million or 45 million naira today is better for me as a business than waiting 60 days, because I also want to be liquid as a business. So I sell that invoice for 45 million naira. I sell the 50 million naira invoice, I collect 45 million naira, and I move on to other things. That person waits for MTN to pay the 50 million naira to them and makes 5 million naira for the business. So you can see that the market can be very dynamic in its operation. So that's what you have, changes in working capital there. It's actually important to see your net cash flow from operating activities. And you can see cash flow from investing activities, sale of property and equipment. So if you sell property and equipment, is an income. If you go into acquisition, it's an outflow of cash. So because it's flowing out, you can see negative, okay? And you can see net used in cash flow. You add all that together, and you have that. I would show maybe a few other things. Then you have cash flow from financing activities, okay? Net change in cash and cash equivalent, beginning of the year. Okay, sorry, this is finance income. If you borrowed money, dividend paid to shareholders, capital from investments of investing activities, right? So, or I think this one actually means capital that came into the business. This is a $10 million capital raise, okay? So cash flow is also important in the sense that you have a budget, okay? So you want to determine, for instance, how much money do I need upfront to finance my strategy, my growth strategy as a business, right? So you factor all those prepayments. Oh, I need to pay for my rent 3 years. I need to lock it down. Marketing expense for the next few years, all of those. You pull out those numbers, and you then sort of do the computation to ensure that you raise enough money at the right time to ensure that you are cash flow positive within the business. All right. So you must be able to raise cash, your cash injections at the right time, because sometimes if you raise money from private investors, institutional investors, they may want to give you those money in tranches. So you want to say, guys, I need $7 million to start first, which is what this business is saying. First, give me $7 million. I'm raising 10, but give me 7 million minimum first. And then year 2, you can give me $3 million. There are implications to this, but I don't want to boss with that. Then this is your statement of financial position, everything I spoke about. So this is typically how everything looks like, right? A financial statement. You can see historical performances here for the business, and a lot of metrics is pulled out from here. You can see growth rates and all of that actually feeds into also how you are projecting the business. You do a lot of financial analysis on the extant position of the business. This is more like you're building a financial model now. So there are things you call, and I'm just trying to do this because I saw Mr. Nelson spoke about financial models earlier. So there are things you call like assumptions, okay? Assumptions you're going to make in a business. Okay, so these are assumptions. How many students, for different programs, right? So how much money you want to go raise, right? So if you want to go raise $10 million private equity, you need very detailed, bankable financial model. And it's all about nitty-gritty details, right? So your modeling skills have to be top-notch, right? So those are controls. These are still controls in terms of assumptions. So when you do all your assumptions, factor your growth, everything, right? Then all of those numbers I showed you is what pours into this financial statement, into this financial model, right? And then there are other things. Let me see if there's a valuation page here. So these are historical numbers here. Okay, the valuation isn't here. Or maybe I can pull an example out from somewhere. But I think maybe I shouldn't go too far. Let me leave the floor for questions, please. So this question says, question with pricing. So in a situation where one's business is in a competitive market that has a sort of a mixed price and overheads are eating into one's net profit, how can one scale? Well, oftentimes you would have, there'll typically be a lot of maybe questions to ask to determine the right answer for the business. There are all kinds of strategic approaches that you can take, but what I perceive here is that the market is very competitive. In other words, you are in a very bloody market where it's probably difficult for you to raise your price point, and your overheads are clearly eating into the business. If you discover that if you are in this trap, quote and unquote, and you have good cash, right? You have good cash, you would have a lot more options in terms of the kind of decisions you can make, as a strategy for a business. But generally, as a rule of thumb, it's not very good for you to be in a bloody market where there is a price war. Once the market is very competitive, the profits that everybody is going to be able to make from that market is going to be very thin. And if you are not a dominant player in that market, the likelihood is you are going to just probably continue to survive until the business dies. So you must make a strategic decision, right? And you must think about, okay, you're talking about scaling. You need to think a lot about technology, right? If you have something that you've built that is of value, and you believe that maybe with incorporating technology, I could scale this business. If you can't buy the technology skill, you can sell your vision to someone who can deliver that technology skill for the business. You understand? Oftentimes, tech is about people who can actually code out technology, who can code out software, or who understand how to do digital or implement digital initiatives and all of that. You probably want to find a way to go and buy that kind of skill, right, in the market. Buy the skill means that the person is going to have a skin in the game. You're going to say, okay, fine, come, look, I have something of value here. There's an opportunity. You need to be able to paint the opportunity, which is where your research comes in, and say, look, we can make a lot of money, if only we can go digital with this business and, sort of achieve our scale, right? But you really want to innovate, which is where maybe the application of tech probably comes in. And other initiatives. If you have a lot of cash, you can do a lot. But in a bloody market, only the guys who have significant market share in that market will survive for the longer period. But more often than not, you find that a lot of them, if they see the market is really bloody, they're already looking for ways to exit the market. Okay. So if you are in a market that has significant price war in the market, overheads are jumping, you have to make, and if you can't make clear decisions, you can continue to run the business, but if you see there is no way going forward, like you can't really see how you're going to pull it out in the future, you need to start thinking about something else. You need to think about a pivot. You need to think about exiting that market or even selling your business. I don't know whether in any of the sessions we had anything that dealt with. Let me see if I can pull it out. Let me pull out something that maybe would inspire you to go and do a bit more study with respect to this. Just a second. Let me see. I think it should help us. Okay, I think I should have something like that here. Just a moment. Okay. Oh, I don't have it here. Sorry, let me just I want to show you an analytical framework that sort of it helps with this particular question and could probably help us with decision making. Sorry, let me just trying to check for it. Okay. Is there another question? I think another question came in. Can someone help me read it out? Maybe I can be answering that question while. Anybody can help, actually.
Okay, the question says, sir, are there rules of thumb like core basis to look out for in translating financial statements into strategy?
Okay. Core basics to look out for. So what you do is not so much as translate financial statements into strategy in that sense, but I think I get where you're coming from. It's that your financial statements give you insights. From it, you distill insights, right? Analysis that would help you, okay, to make decisions in terms of your strategy as a business. Okay, so a very simple, example, right, is if you, for instance, look at your cost as a business and you look at your revenue to employee ratio and you find out that it's too thin, okay, maybe even compared to a competitor, particularly maybe you publicly quoted. A lot of the banks do that a lot, right? And I think GT Bank for several years has had the highest performance in terms of revenue to employee ratio, in terms of employee cost now, right? It may lead to a decision to say, you know what, it means that we are overstaffed as a business. Our numbers is telling us that we're overstaffed. Our staff right now, our staffing is not optimal, right? We are paying a lot of money out in salaries, and we're not getting the top line bang for how much we're investing in paying salaries. So they may decide to lay off, for instance. They may project the market and say, okay, fine, we made this much income while we have this much cash in the business, okay? Like you find in the oil and gas industry some years back, they looked into the future and they felt, well, oil price is coming down and is going to be coming down for the foreseeable future. So they had a lot of cash and they decided to incentivize the staff members to take a payout and leave. So they called in consulting firm and said, you know, help us with this computation. So they offered people some good bounty to leave the business as a first option. Option B would be, okay, if nobody's leaving, then we will go the other route of actually now looking at those who are not maybe delivering a lot for the business, and then we lay them off. Okay, so that's like an example, right? It's a basic one, but what the financial statement can give you are insights that you can use to actually make those decisions. Okay, I think there's another question. Can an operational business leverage on cash flows to define its shape? For instance, at the self-financing stage, you mentioned something about how intangible assets are defined and valued. Can this factor be inferred to create a financial model starting from the cash flow? I'm not sure I understand that question. Can an operational business, a business in operations, leverage on its cash flows to define its shape? At the self-financing stage. I'm not sure I understand that statement. I don't know, Mr. Jeremiah, if you can unmute and maybe give a bit more light to the question. I think that would be helpful. Or if anybody feels, if you understand the statement and you can help.
I guess the question.
Okay, I'm listening. Sorry. Yes.
You mentioned something about
I can't hear you. Sorry.
insurance. They are liquid. Actually, the reality remains that
sorry, I can't hear actually. Sorry. Hello, Mr. Is this still on? Mr. Jeremiah? Or am I the only one? Can anyone hear him?
I can hear you, sir.
So the first comment by
Yes.
please choose one. I don't trust you.
I think we lost Jeremiah. Jeremiah, you're not there. Yeah, we lost Jeremiah. So you were answering his question, but apparently the internet has gone off.
Oh, wow. Okay.
Okay, let me maybe explain so that we can all get the issue of the substation. The substation is an investment by Kaduna State.
Okay, I think that was probably okay. Let me see if I can. Let me project this to help so the question that was asked initially, this is like a strategic framework that helps for decision making. It was developed by BCG. It's popularly called the BCG matrix, or what you call the growth share matrix, right? What you have on the vertical side is business growth rates. Okay, sorry. And then relative market share. I think these guys have flipped it. I'm used to the business growth rate being on the, I just had to quickly go on the internet. I couldn't find the one I could use personally very quickly, which I think would have helped with actually seeing how, you know, decisions are made very, very clearly. So I think the convention really is market share on the vertical, but it doesn't matter. So business growth rates, right? And then relative market share on the x-axis. The y-axis has business growth rate. Okay. So what this means is this, you know, when they say something is a cash cow, right? It means it's generating a lot of cash for you as a business, right? What it means is that your relative market share is very high, but the business growth, it's not growing as an SBU, right? It may be a product, it may be an SBU, whatever. You know, it's not growing again. It's just stagnant. You're making like about the same amount of money every year in your numbers. You know, the market is probably not growing as well, right? So, but you have a big market share. So you'll be making a lot of cash flow as a business. I would give an example. Okay, I will hide the name of the bank. One of the banks, one of the major banks, wanted to sell one of their SBUs recently, and they had actually literally completed the transaction sale. But because of the whole dollar issue, you know, the investors kind of backed out, right? And they decided to invest a small amount of money in another company. But this particular business, it is making serious cash for this particular bank, right? And they wanted to sell a percentage of that SBU, right, to a private equity investor. I mean, crazy valuation, right? It's like their fintech part of the business that they were trying to sell. So it was massive cash cow, and they were ready to cash in on it. So what you do for cash cow, you can see the decision there is to harvest. Harvest means that, sorry, maybe I should use my pen. Harvest means that you don't want to be investing in that cash cow, which is a mistake a lot of businesses make, right? When you have a cash cow and the market is not growing, right? The market for that business is not growing, and you have big market share, you don't continue to invest, right? To say, oh, let me go and put much more of this into this business. You find some businesses, they are at high risk because this cash cow is probably all they have, and they continue to invest in it. When you have a cash cow, you need to harvest the money, the cash coming from that business, and you invest that cash into these two. Typically, this one is definitely invest. This one is a question mark. Should I invest or should I divest, right? Unfortunately, there are some businesses now, very smart businesses, before this cash cow moves from here and becomes a dog, literally a liability. A dog is a pet, meaning that it's just nice to have. I just like this business. It was my first, this is the first way I started business. It's not making you money. It's not, you know, you're making low money. You're not, nothing is happening. You sell it, right? The smartest people, before this cash cow becomes a dog, because this is the journey, it's going to become a dog, you harvest when the ovation is loudest, right? So I'm showing this because of the question that was asked, right? Because very likely what you have as a business, if it's a very competitive market, right? And you are struggling to increase pricing, you are likely already having a dog in your business. If you can't convert this dog, you're either having a dog or perhaps you have a question mark. Question mark may come in what we spoke about. Is that something I can do, innovation, that can kick this business into a growth trajectory, right? And we'll see how that is doing. Maybe if I show some results, maybe there are some investors that may look at it and say, okay, you know what, let's take a bet. Let's give you money so that you can move into this place where you are a star, okay? So dog, divest. If you judge that what you have in your hands today is a dog, please sell that business. Just find a way to sell it or close shop. You understand? If you feel you have a cash cow, don't bother with trying to invest. Just know that, well, this is it. Let me expand. Let me create a different product, a different market, a different whatever that can be put in a growing market, right? And I probably would become one of the big guys in that market. You understand? So the businesses you want to really retain, if you have a cash cow, retain your cash cow, but continue to milk it. Don't invest, or don't invest too much capital in it. Invest that capital in a new business. And I've seen many people do this over and over. Smart business people who divest, right, and move. So I think I should stop that there before I go too far on this. But I believe that, I mean, I hope this helps with that question to an extent. Okay. Anytime Mr. Richard is back and is able to maybe shed more light on the question, we can take more. Josiah Wobodo, sir, are there rules of the thumb like core basics, lookup for interest? Okay, we've dealt with that. About depreciation, are there any formulas or percentages to calculate it? Yes, there are. For example, a company that has buses, multiple, yes, definitely. There are standard depreciation models for cars, for productive assets, and all of that. So I think they all have, you can check, I think IFRS actually has a standard. IFRS is sort of the regulatory body that tries to regulate the accounting practice to ensure that there is standard, or, you know, someone is waiting, okay. That you know, accounting practice is standardized, and, you know, best practice are also followed in accounting practice. So you can check online, you'll see different standards for different types of equipment. Many you find fall into the category of 5-year cycle, 5-year life cycle. You depreciate the business over 5 years, which means you take a 20% depreciation every year on the business, on the asset. So if you buy it brand new, for instance, you just want to ensure that perhaps in another 4 years, you are able to have enough cash to actually replace that asset. And, you know, technology is moving very fast, so very likely you have a new model coming out. So sometimes before you even wait that long for certain types of assets, you may not be able to wait to fully depreciate the asset so that competition doesn't take you out. Because the other people who are producing that asset, they also want to sell, so they release a new version, right? That's what Apple and Co does. And all the mobile networks, they release a new version into the market. And if your competitor buys that and is able to operate more efficiently than you, you'll be under pressure to also just go ahead and, buy or acquire a new asset. So it's a highly competitive market. But yeah, you can check online, you find different standards for different types of equipment that would help you. Okay. Mr. Okona, I believe maybe at this point I'd hand over to you.
Wow.
Thank you, everyone.
Ladies and gentlemen, can we give it up for Pastor Mr. Ayodeji Kurunmi? You can unmute and just appreciate it.
Thank you so much, sir. Thank you so much.
Thank you for having me.
So, Mr. Ayodeji, we're a small class. We're starting.
Bishop Nelson.
Thank you, sir. We're starting. But I want to assure you that the sacrifice made today in delivering these sessions will not be in vain. We're already seeing significant feedback from our people. And I can use the opportunity to share maybe a case study that I'm sure you can relate with. One of our participants for the immediate past EMTs, by name Mr. Jeremiah, somebody that, at the time I might be thinking, is he getting it? Are they getting it?
Yeah.
Well, support for you today, Jeremiah is a lead staff at BOI.
Wow.
He's a star model. I mean, he does business models like, hell. So he was just telling me that one of the big firms, in the country, we are asking if you should come in to be their investment advisor. Do you understand? So,
nice.
So Jeremiah was on the same level with everybody here now.
Amazing.
So just to encourage you, sir, the participants here, I assure you that they have got the stuff and they will make it.
Sorry, actually, let's talk time.
Yeah, no. I know the Jeremiah we got it, but it's not your own Jeremiah we're talking about, though. But just to thank you, sir, for the sacrifices and that will make you proud. Thank you so much.
Thank you. It's a big pleasure. Thank you so much.
Thank you so much. And then thank you everyone for making it. In our debrief sessions, we'll ask more questions. And if you have anything we need to send across to Mr. Ayodeji to clarify for us, we will do so. Thank you so much, sir. God bless you.
Thank you.
Thank you,
I'll
sir.
be glad to answer any questions subsequently. Yeah.
Thank you, sir.
Thank you.
Okay,
all right,
sir.
Enjoy the rest of the evening.
Thank you, sir.
Thank you.
Okay.
I'll take my leave. Thank you. All right.
Okay, everyone remaining. Thank you guys for hanging in there. And I believe it was a worthwhile session for all of us. I hope it made sense. This is family time now. Any feedback can give me straight up.
Yeah, it made sense. So it made sense, yes, sir.
I heard when he was asking you guys to ask questions, nobody was asking. I was like, hey, this people would just me again today.
The session just served to provide us with the. I think you had taken us in some deeper part of this work. So this one provided the balance, like the basics, and provided insight into understanding a lot of those things. I think that's what happened here. So
okay, you guys were ahead of the curve. Yeah. Is that what you are saying? I don't think so.
Yes, to an extent. No. Okay. Not on the technical terms, but as for understanding those cash flow and ROIs and stuff.
Okay. Yes. Okay, gentlemen, we have a lot to do. Tomorrow we'll still have a lot of sessions, 2 sessions to be precise. So let's try and rest. Thank you and God bless you. Bye. Bye-bye.
Thank you, sir. Good night.
Good.